Two Nigerians earning the same amount of money can end up paying very different taxes legally. In this video, I'm going to break down Nigeria's new tax laws so clearly that by the end, you understand them better, like most accountants, without being one. This video is in Q&A format, so feel free to use the chapters to jump straight to the questions you care about most. Let's jump right in. Tax is simply the money we pay to government in exchange for public services. Things like roads, hospitals, power supply, and security. The idea is simple. The government creates an environment where you can earn money, and when you earn money, you return a small portion to the government so the system can keep running. Different people pay different types of tax. As an individual, you pay personal income tax, also called pay as you earn or payee, when it's deducted from your monthly salary. As a company, you pay company income tax on business profits. Everyone pays value-added tax or VAT when buying goods or services. You usually see it on your receipt. There's also capital gains tax when you sell assets at a profit. Stamp duty is paid on certain documents, and customs and excise duties when importing goods. And finally, withholding tax. This is not an extra tax. It's simply an advance payment of income tax that is settled later when you file your returns. When people ask me this question, they usually mean one of two things. One, is money in my bank account taxable? Or two, can the government just wake up and take my money because of tax? Let's answer them one after the other. First, just having money in your bank account is not taxable. Only income is taxable. Income includes things like salary, business profit, or interest earned. Money that merely passes through your account is not automatically taxable. So how does the tax authority know the difference? The answer is record keeping. You are expected to keep proper records showing where your money comes from. If you can clearly explain the source of funds, it is not treated as income. But if you cannot explain where money came from, the tax authority may legally assume it is taxable income. If you're unsure how to document your money properly, join the free email list in the description of this video. I'll be sharing practical tips on how to keep clean, defensible records. And now the second fear. This is a very common fear, but let's separate law from panic. Legally speaking, yes, under Nigerian tax laws, the government can enforce unpaid tax by attaching or placing a lien on your property. This is deliberate. Tax laws everywhere recognize that they will not be obeyed if they cannot be enforced. But, and this is important, enforcement must follow due process. Before that power arises, several steps must happen. First, your tax liability must be properly assessed. Second, you must be formally notified. Third, you must be given the right to object or appeal. Only if you fail to contest it or you lose after due process can enforcement begin. In practice, enforcement actions like account attachment or property seizure are rare for low-income earners. Governments go where enforcement is economically worthwhile. Before 2026, individuals in Nigeria were taxed using these progressive tax brackets. You paid 7% on the first 300,000 naira you earned. The next 300,000 was taxed at 11%, and the rates increased gradually up to 24% on income above 3.2 million naira. On top of that, individuals also had something called the Consolidated Relief Allowance, CRA. CRA allowed you to automatically deduct at least 21% of your total income before tax. So a large part of your income was completely tax-free before any tax was calculated. But from January 2026, the personal income tax brackets change. The good news is the first 800,000 naira you earn is now taxed at 0%. After that, the rates jump to 15% for the next 2.2 million, with the rates gradually rising to 25% for income above 50 million naira. In other words, low-income earners pay less, while higher earners contribute a little more. Then that 21% or more CRA is gone. Instead of CRA, the law introduces itemized tax reliefs. For example, you can now claim rent relief of 20% of your rent, but it is capped at 500,000 naira, so you can't claim more than that. There are also other reliefs, but they must be verified with proper records. This is a major shift because now reliefs are no longer automatic. If you don't have documentation, you cannot claim them. Companies, on the other hand, are treated very differently. They pay a flat tax rate between 20 and 30% of their income, depending on their size. So for many years, operating as an individual was often more tax efficient than operating as a company. Until 2019. In 2019, the Finance Act introduced a major change. Small companies making 25 million naira or less started paying zero income tax. That was the beginning of a shift in Nigeria's tax structure. That 25 million naira has now been raised all the way to 100 million. From 2026, a small company is now defined as one that makes 100 million naira or less and has total fixed assets not exceeding 250 million naira. So if you fall into this category, you pay zero company income tax. That's right. You can legally run a company and pay nothing in income tax as long as you stay within these thresholds. And the benefit doesn't stop there. These small companies are also exempt from capital gains tax and the new 4% development levy that applies to bigger companies. So for many business owners, the message is clear. Under the new tax laws, registering a limited liability company with CAC suddenly makes a lot of sense, especially for content creators and freelancers. As a content creator or freelancer, you can still show up publicly as an individual, but operate financially as a company. Your brand deals, partnerships, and endorsements are paid into your company bank account. Your invoices carry your company name. Your operating costs become business expenses. And as long as your company qualifies as a small company, you pay zero income tax at the company level. Under Nigeria's new tax laws, Many people and businesses will legally pay zero tax. Let's start with individuals. As an individual, you will not pay personal income tax if your taxable income is 800,000 naira or less, or you earn the national minimum wage, because income within that band is taxed at 0%. You will also not pay tax if you receive pensions, gratuities, or retirement benefits. Compensation for loss of employment is not taxable up to a maximum of 50 million naira. Gifts, provided they meet the conditions set by law, are also not taxable. Remittances from abroad, as long as they come through proper banking channels, are not taxable. Interest earned on federal government of Nigeria bonds and securities remain non-taxable. Now let's look at businesses and companies. Under the new framework, companies with annual turnover of 100 million naira or less and total fixed assets not exceeding 250 million naira will pay zero income tax. These companies are also exempt from capital gains tax and from the new development levy. There is also no withholding tax deductions on their income. In addition, some agricultural businesses enjoy tax holidays of up to 5 years, and some qualifying startups will receive special tax exemptions. Now, for everyone, regardless of income level, there is no VAT on basic food items, rent, healthcare and medical services, education services and materials, and shared transportation. Finally, there is no stamp duty on salary payments and also on intrabank transfers. But tax exemptions does not mean you disappear from the tax system. Even if your tax payable is 0 naira, you must still register for tax, keep proper records, and file your tax returns. Charities, churches, mosques, and non-governmental organizations are generally exempt from income tax. However, that exemption is not absolute. First, staff members of these organizations who earn salaries are still required to pay personal income tax. Second, if the organization itself engages in commercial or business activities, the income from those activities may be subject to tax. So, while the organization may be exempt, people earning income from it are not, and business income does not enjoy automatic exemption. There is a very common misconception about tax. Many people believe that once you earn more money, you suddenly pay a higher tax rate on all your income. That belief is wrong, and it sometimes makes people unconsciously resist earning more. Nigeria, like most countries, uses a progressive tax system. What that means is simple. You're taxed step by step, not all at once. You never pay one single percentage on your entire income. Each portion of your income is taxed at a different rate. Let's use a simple example. Assume you earn 15 million naira in a year. You might feel that this puts you in the 21% tax bracket, but that does not mean you pay 21% on the full 15 million. Here is what actually happens. The first 800,000 is taxed at 0%, so you pay nothing. The next 2.2 million is taxed at 15%. The next 9 million is taxed at 18%, and only the remaining 3 million is taxed at 21%. Each bracket is applied only to the portion of income that falls inside it. So even though your total income is 15 million, most of it is taxed at lower rates. When you add everything together under the new tax brackets and without any deductions, the total tax payable on 15 million comes to about 2.5 million per year. That's how progressive tax works. You earn more, you keep more, and you're only taxed a little higher on the next layer of income, not the whole thing. One of the easiest ways to reduce your tax is by using what the law allows, called reliefs and statutory deductions. They are the amounts you are permitted to remove from your salary or income and keep for yourself before tax is calculated. I am already reducing the tax I will pay in 2026 legally. Most people won't because they don't understand tax reliefs. Let me show you one deduction you can use. So you make 15 million in a year. If you do nothing, the government taxes the full amount. But here's the difference. If you put part of your income into a pension contribution, that portion is not taxed. It goes straight into your pension account legally. Now, assume you contribute 2.5 million to your pension. Your taxable income is no longer 15 million. It becomes 12.5 million. That means you pay tax on a smaller amount and your total tax reduces. The key thing to understand is this: reliefs reduce what is left before the government applies tax. Under the new tax laws, CGT still applies, but there are important exemptions you need to understand. Let's start with shares. Mind you, when selling any asset, only the gain is taxed, and gains from the sale of shares are exempted from capital gains tax if the total sale value is below 150 million or the profit made is 10 million or less. If your gains exceed these thresholds, the gains may still be exempted if they are reinvested within the time allowed by law. So CGT on shares is not automatic and reinvestment matters. Now, for individuals, capital gains tax is charged at the same progressive rates as personal income tax, no more flat rate. However, some individual assets are still completely exempted from capital gains tax. For example, the sale of an owner-occupied residential house, then personal effects valued up to 5 million, and the sale of up to 2 private vehicles in a year. They are exempted to make sure that everyday personal assets are not taxed like investments. For companies, capital gains tax becomes more significant. Under the new tax laws, the CGT rate for companies increases from 10% to 25%. This means that when a company sells assets or exits an investment, a much larger portion of the gain may go to tax if there is no proper planning. This is why exit planning is extremely important for businesses. How and when you sell assets, whether you reinvest, and whether the sale happens at the company level or the individual level can make a major difference to the tax outcome. Under Nigeria's new tax laws, digital assets are no longer ignored. Cryptocurrency, NFTs, and other digital assets are now clearly recognized as taxable assets when they are sold or disposed of at a profit. This means if you buy crypto or any digital asset and you sell it later and make a gain, that gain may be subject to capital gains tax. The key issue here is documentation. Record keeping matters even more for digital assets. Wallet histories, exchange statements, and transaction records are no longer optional. For companies and startups dealing in digital assets, the same principle applies. Gains may attract capital gains tax or company income tax depending on how the activity is structured. The bottom line is this: crypto itself is not illegal and it is not automatically taxed. Only the gains are taxed. No gain, no tax. But once there's a profit, the tax conversation starts. If you are a diaspora Nigerian living and working outside Nigeria and you are not tax resident in Nigeria, you don't pay Nigerian personal income tax. This position does not change under the new tax laws. However, things are different if you are considered tax resident in Nigeria. You may be tax resident in Nigeria if you meet any of these conditions. If you spend 183 days or more in Nigeria within a year, or you maintain a base in Nigeria, or Nigeria is your center of vital interests, meaning your economic or personal ties are mainly in Nigeria. If you are tax resident in Nigeria, then you may be liable to Nigerian tax on all your income, including income earned abroad. That income would then be assessed under Nigeria's progressive tax brackets. The key point to note is that remittances are, however, not taxable. If a diaspora Nigerian sends money home through proper banking channels, the person receiving the money does not pay tax on it. Also, where a double taxation agreement exists, for example, if you live in any of the following countries, a DTA applies. It helps ensure that the same income is not taxed twice. The takeaway is simple: non-resident Nigerians abroad will not pay Nigerian income tax. Tax residents may be taxed on their worldwide income, and remittances remain tax-free. Under the new tax laws, tax payment is largely based on self-assessment, meaning you are responsible for declaring your income, calculating your tax, and paying your tax before the deadlines. So how do you file and pay your tax? Assessment, filing, and payment will be done through the official government tax portal designated for this purpose. Once fully implemented, this portal will be used to file returns, make payments, track compliance, verify reliefs and exemptions. It is important to note that going forward, the tax system will now rely on a unified identification framework, which simply means that individuals will be tracked using their tax identification number or tax ID or national identification number, NIN. Companies will be tracked using their CAC registration number. And these numbers, these identifiers, will link your tax records across agencies. If you believe the tax amount assessed against you is wrong, you are not stuck with it. Under the new tax laws, you have the right to challenge an assessment. But the law says you must do this within 30 days, or the assessment will become final. The first step is always to request clarification, ask for a review, and provide records or evidence. Many disputes are resolved at this stage once documentation is provided. If the issue is not resolved, you can escalate the matter to the tax ombudsman. The tax ombudsman is designed to be independent, neutral, and accessible. Their job is to review complaints against the tax authorities and protect taxpayers from unfair treatment, which is especially helpful if you can't afford an accountant or a lawyer and you believe you were assessed unfairly and you were not given a fair hearing. This is support that did not exist before for many ordinary taxpayers. And yes, it's important to note that the tax ombudsman does not cancel tax automatically. But if your position is valid and supported by records, the tax assessment can be reviewed, corrected, or even withdrawn. Tax compliance is mandatory, but fairness is also the law. Pay what you owe, but only what you truly owe. Thank you for watching. If this was helpful, please like the video and subscribe for more practical tax explanations. See you next time.